Yes, 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 yes. This will be a P&L charge. This will be a P&L.
Separate or just together?
It'll be a finance cost. I mean, you'll be explained in the notes. It'll be a finance cost. Equity instruments. Evidences an ownership interest. Evidences an ownership interest. There are no obligations. Includes contracts to deliver a fixed number of shares for fixed consideration. So equity shares, equity instruments is evidence of ownership interest where there are no obligations. No, if you have an obligation to pay money, then the obligation to pay money is a liability. So an equity instrument is where there are no obligations. It would include contracts to deliver a fixed and fixed. Yeah, fixed and fixed. Fixed number of shares for fixed considerations. For example, an ordinary share is an equity instrument. An ordinary share is an equity instrument. Is a preference share an equity instrument? No. I'm keeping it as short and sharp and simple as asking you whether a preference share, okay, if you want any form of clarification, I will say a cumulative preference share. If you want any form of clarification, I will say a cumulative preference share. A preference share. Does that create a liability? Yes, it does, because they have a contractual right to receive a dividend. Yeah? And if they have a contractual right to receive that money, then a preference share is debt. A preference share is a liability and not an equity instrument. So, preference shares are debt. They have a contractual right. They have a contractual right to receive cash. Company has an obligation. Company has an obligation. So we think of it as debt. Yeah? So a bit of a trick there. It's not an example of ordinary shares are an example, but equity shares, ordinary shares are an example of equity, but preference shares are to be thought of as debt. Preference shares are debt. Preference shares are debt. Preference shares are debt. So, what do we know about?
Company has an obligation to pay dividend.
Correct. So under a preference dividend, you say, I will give you a 4% dividend every year. Yeah? So that 4% dividend is creating a liability that we have. Yeah? So you would recognise the receipt of money from the issue of preference shares, debit cash, credit liability. And that would mean that the preference dividend was a finance cost in the P&L. So, yeah, think of the substance, think of the truth, think of the economic reality of what is happening. Preference shares are debt. Preference shares are debt. Ordinary shares are equity. If you are an ordinary shareholder, you cannot sue the company and say, you haven't paid me a dividend, where is my money? You have no right to receive that money. That's the definition of equity, no obligation. Classification, there isn't a classification process. Initial recognition is fair value less issue cost. So initial recognition is, initial measurement is fair value less issue cost. So initial measurement will be like amortized cost, yeah, fair value less issue costs. In other words, to put it another way, at the net proceeds of issue. Now I'm going to say something very simple, very important, very basic, yeah, and maybe a little bit patronizing. I'm a company and I issue an equity instrument. It's a $1 share, okay? So you give me $1, you give me $1, I receive $1, and I give you a share. I'm under no obligation to pay you any money. I may or may not pay you a dividend in the future, but you now own a $1 share. 3 years' time, 4 years' time, that share is now worth $5. Who's made the profit? The issuer or the investor? The investor. The investor now has got an asset worth 5. In terms of my accounts, what do I do with my equity instrument? Nothing, correct. The equity instrument is not remeasured. The equity instrument is not remeasured. Nor does the equity instrument create an expense. Because if I have a dividend, the dividend that I pay doesn't affect the carrying value of the equity instrument. The dividend that I pay is an appropriation of profit. If I pay something to a creditor, it reduces the creditor. But if I pay something to my shareholder, it doesn't reduce the carrying value of the equity instrument. So the equity instrument is boring. Nothing happens. Nothing happens to the equity instrument. And this sort of makes sense if you remember IFRS 2, when we looked at share-based payments. I kept on saying that the option that we have when we give directors options, that the options are valued at the grant date, and the value of the option at the grant date doesn't change because that is an equity instrument. So, initial recognition is fair value less issue costs. Subsequent accounting, none. Subsequent accounting, none. If you pay the money, dividends paid, it's appropriation of profit. It doesn't impact whatsoever. Classification of financial instruments issued, classification of financial instruments issued, debt versus equity. if you are a creative accountant and you are raising finance, debit cash. So I issue a piece of paper, I receive money in. Would I rather show what I have issued as debt or equity?
Equity. But depends. Sir.
If I classify it as debt, then I have an increase in my non-current liabilities. If I say the money I have received, I have an obligation to pay back, then my non-current liabilities go up. What does that do to my gearing?
Go up.
It'll increase my gearing. It will increase my gearing because I now have more debt. I have said the same thing 3 times. If you borrow money, you've got more liabilities. If you classify the instrument and say that you have an obligation to pay the money back, it's debt. It's gearing. If you walk into the bank and you are up to your eyeballs in debt and you have a very high level of gearing and you ask to borrow money,
Thank you.
you'll either be rejected or
Thank you.
they will charge you a high rate of interest. So it's going to make it more difficult, it's going to make it more expensive to borrow money.
Yeah.
Debt is ugly. Yeah? Debt messes up your balance sheet. Debt is ugly. Yeah? So therefore, it is harder, it is more expensive to borrow. It is ugly. Okay. What's the impact of the P&L? If you borrow money, what are you then going to charge in your P&L?
Interest.
Finance cost. Yes, finance cost. So there's going to be a finance cost. So you're going to have more finance costs. And if you've got more finance costs, you're going to have less profits. Oh dear, that's not pretty either. As a business, I want to report high profits. As a business, I want to report high profits. So if I'm calling it debt, I'm bringing ugliness into my financial statement. If, on the other hand, I call it equity, if, on the other hand, I classify the instrument as equity, then I will have more equity. Yeah? What's that going to do to my gearing?
No,
Gearing will go down. Gearing will go down because I have more equity. I mean, I'm saying the same thing. Gearing will go down because I have more equity, and therefore it's going to be easier. It's going to be cheaper to borrow. It's going to be easier. It's going to be cheaper to borrow. It's going to lower your cost of capital. What's the effect in the P&L? No, no. Yeah, no. Dividends paid are a movement on reserves. Dividends paid are an appropriation of profit. Dividends paid are not an expense. So, look, what I need you to do is step back. What I need you to do is look at the big picture. If we're issuing a financial instrument, what you and I must do is the correct thing and the ethical thing. Yeah, the correct thing because we're competent, the ethical thing because we have integrity and we want to show a true and fair view. So if we have borrowed money, we should show it as debt. If we have issued equity instruments, we should show it as equity. But a creative accountant, somebody who is unethical, might prefer
Equity.
to show it as equity. Because by showing it as equity, you're protecting a profit, you're protecting the gearing. So that's a double reason for wanting to show things as equity when they may not in substance be equity. Oh, it's 3:30. I was just checking on the time because we now have some examples to do. And the examples take 20 minutes, half an hour to roll. But given that it's 3:30, we are perfectly on time for taking a break.
Thank you.
So let us take a break.